Welcome back. My name is Quinton Friesen, and this is Module 11 of 15 in the course 4 Essential Disciplines, a training guide for healthcare leaders worldwide. My colleague, Ken Hekman, and I are leading you through 15 modules to help you improve your skills, knowledge, and attitudes as a healthcare leader. In this module, we'll focus on how leaders track progress toward goals.
Perhaps one of the most important responsibilities of a leader is tracking your progress toward goals. Without tracking, it's impossible to gauge your progress. As you measure progress, you measure actual performance against your plan. It allows you, as the leader, to make course adjustments or continue what you have been doing. In this session, we are going to focus on financial tracking. Our learning objectives are to identify the components of a financial balance sheet, to identify the components of an income and expense report, to discern steps to assemble a flexible financial plan, and to understand how managers control budgets.
In order for an organization to survive, it is crucial that it have accounting records to track the financial transactions of the organization. There are 2 financial statements that every leader should understand: the balance sheet and income and expense statement. First, a balance sheet is like a snapshot of your financial condition at a given point in time. It will describe your financial strength or weakness. Over time, it will tell you whether the financial strength of the organization is improving or deteriorating. On the last day of each month, it shows assets, what you own; liabilities, what you owe; equity, what you own free and clear. These are balanced in the following manner: assets equal liabilities plus equity, or alternative, assets minus liabilities equal equity. Hence the term balance sheet. The leader's goal is to increase equity, what you own free and clear, over time. Without equity, the organization cannot sustain itself or stay in business. Negative equity will result in bankruptcy, and the organization will cease to exist. You will want to keep track of equity regularly to see whether the organization is getting financially stronger or weaker over time. Depending on what you see, you can take actions to adjust your course of action so that the organization can stay in business. Let's look at an illustration of a simple balance sheet. You will note assets are on the left-hand side of the table. Liabilities are on the upper right-hand side of the table, while equity, or owner's equity, is on the lower right-hand side of the table. If you look at the total assets, they will equal the liabilities and owner's equity. Comparing these totals will show you the financial condition of the organization over time. In this example, you will note that equity was a negative $6,319,000 on December 31, 2012. This compares to a negative $678,000 on December 31, 2013. This means that the organization is stronger, since its negative equity has been reduced from one year to the next. This example simply gives you an example of what a balance sheet might look like. By taking a finance course, you will learn the details of reading a balance sheet and what makes up the numbers on the sheet. If your organization is profitable, your equity will grow on the balance sheet. If you are losing money, your equity will decrease.
The second major financial document that leaders should be acquainted with is an income and expense statement. An income statement is in this form: revenues equals money that comes into the business, expenses equals money that flows out of the business, profit or loss is what is left over after expenses have been paid. If it is positive, you've made a profit. If it is negative, you have lost money. The goal of an organization is to grow revenues and decrease expenses, making a profit so the organization can continue. If it is profitable, the organization is sustainable and can continue to pursue its mission. Let's look at an example of an income and expense statement. An income and expense statement is read from the top to bottom with revenues in the first lines of the statement followed by expenses. At the bottom, profit or loss will be recorded. In this example, revenues increased from just over $82 million to $84 million, while expenses decreased from $100 million to $83 million. This means Hope Hospital moved from a $17 million loss to a $1 million profit in 1 year, a financial turnaround of more than $18 million. This illustration simply gives you an example of what an income and expense statement looks like. Further information can be gained by studying finance and accounting.
Budgets enable the leader to forecast expected volumes, revenues, and expenses. Careful budgeting can help to assure that the organization remains profitable and sustainable. To assemble a budget, the following activities will be necessary. First, you will want to forecast volumes of patient admissions and days in the hospital, lab tests, radiology procedures, surgeries, and other types of volume that will generate revenue for the organization. It is also important for you to plan your annual capital budget. Generally, capital budget items are major purchases that have an expected life of 3 years or longer. For example, what new equipment or buildings will you plan to buy in the coming year? You will also want to include new programs that are included in your strategic plan. Finally, you will want to budget for working capital. Working capital is the amount of money that you need on hand before you receive payment for the services that you provide. In effect, this is the money that you will use for expenses before you are able to collect the money for the services provided. Once budgets are completed and approved, the leader can use monthly reports that show your actual revenues and expenses, with comparisons to your budgeted revenue and expenses to gauge progress each month. If you notice that the company is not performing as you expected, compared to the budget, you can make decisions to increase revenues or decrease expenses. Each department director will have a budget to monitor actual performance against budget amounts. Each revenue and expense line in the budget will have a budget amount to compare to actual. The department director is responsible to manage the volume and to bring in revenue, and manage expenses to keep costs in line with expectations.
As a healthcare leader or manager, you may be asked to put together a financial plan for a new program or service. It is important that revenues be sufficient to sustain the new program or service. In order to plan the new program or service, you will be asked to assemble a financial feasibility plan to demonstrate whether the program or service can sustain itself over time. What is a financial feasibility plan? It is a prospective analysis of the costs and benefits of a major new initiative, such as a hospital or a clinic in a new location. In preparing a financial feasibility plan, you will need to answer questions like these. What will the project cost to build and maintain in both financial and non-financial terms? What benefits will come from the project, both in financial and non-financial terms? How long will it take before the benefits exceed the costs? What can we expect as a return on investment over time? Should we proceed or not? Is it feasible? That is it sustainable? The following outline can be helpful as you assemble a feasibility study. Begin to write a brief summary that describes the project. Explain what the new program is designed to accomplish. What alternative solutions should be considered? What is the preferred option? What is the scope of work to be completed? If it is a construction project, provide drawings of the new project. What are the construction costs, that is, the capital costs? What are the recurring costs or the operating costs? What is the preliminary business case? That is, what are the expected revenues and expenses of the project? Will it be profitable? Provide an implementation plan and schedule.
In summary, to maintain a sustainable service, each department director should be constantly asking the following questions. How does our volume compare to budgeted volumes? Are we charging the patient the proper amount to cover the cost of our supplies and expenses? How can we lower our costs without reducing the quality of care provided? Are we using our staff as efficiently as possible? Are we buying supplies and services at a reasonable cost? How does our actual income and expense compare to budgeted income and expense? The effective department director will be constantly monitoring monthly financial reports, anticipating changing circumstances, and taking action to keep the organization financially on track.
Let's look at some common questions about tracking. Why do leaders and managers need to track financial results? Isn't that the job of the finance department?
The finance department may be responsible for keeping the tracking systems functioning properly, but every department manager should be responsible for achieving financial results if the healthcare organization is to be sustainable. That is why it is essential for every manager to understand some basic principles of finance and accounting, and to be able to track the results for their own performance.
This sounds like a complex process requiring expensive computers, software, and specialized knowledge. How would this be relevant for a small clinic in a remote area?
The basic principles we have discussed today are essential for every healthcare organization of every size and level of complexity in every setting. If your goal is to sustain the service, you cannot ignore the need to track revenues and expenses and to work toward achieving financial stability. These principles are just as relevant for a village clinic as they are for an urban hospital. Some time ago, we were working with a surgery center in a third world country. While all systems appeared to be functioning properly, the financial system was not functional. It did not provide the necessary financial information, with the result that the center was building up significant deficits, threatening the sustainability of the organization. Fortunately, experienced managers discovered the problem and have worked to install a basic accounting system. The organization is now returning to sustainability. It almost went out of business because no one knew financially what was happening with the organization. We recognize that this material may be unfamiliar to clinicians, and it may seem uncomfortable to talk about money when you have focused your entire career on simply caring for people. But if you are responsible for leading or managing a healthcare service, we encourage you to expand your skills in this area so you can grow your organization's capacity for service and to grow in the quality of care. This concludes Module 11 of the course on 4 essential disciplines. Thank you for participating.